The average homeowner has $206,000 of tappable equity in their home. I mean, come on, that's a lot of money. And that's just tappable. That means that you've left 20% of the equity still in your home. In today's video, I want to talk about a powerful way that you can tap into that asset with something called a home equity line of credit or a HELOC. HELOCs are an amazing way to pull out some of that equity in your home. Often, it's locked up equity that's in real estate. But this tool will allow you to use that equity for things like home renovations, consolidating other high interest rate debt, funding things like weddings or your child's education or starting a new business. And shoot, I've even seen people take advantage of the equity that they've built, especially over the last couple of years, to continue to build multi-generational wealth through building and buying other investment properties using those HELOC funds. And the possibilities are nearly endless. So let's discuss and see if a HELOC could be right for you and your financial picture. But before I dive too far in, do me a favor and hit that thumbs up button so we can reach more people just like you. And if you enjoy content on the real estate and mortgage markets, make sure to subscribe to my channel as well. We put out content every single week. So how exactly does a home equity line of credit work? Essentially, it's a second mortgage. It allows you to borrow money against the equity that you've built up in your home. It also kind of works like a credit card, where you get a maximum loan amount based on your home equity and on your loan qualifications. And you can borrow as much or as little as you need up until you hit that limit. For example, you may qualify for a $100,000 HELOC, but you really only need $35,000 because maybe you're redoing or upgrading your kitchen. You can borrow exactly that $35,000 and leave the remaining $65,000 untouched and also not being charged interest. And here's one of my favorite things about a HELOC. It's revolving. So in essence, you can borrow the money, pay it back, and borrow it again. This just furthers my belief that home ownership isn't just about building wealth, but about creating options and opportunities. I mean, the longer you own a home, the greater your chance of building precious equity, and you can use it as you need. Keep in mind, a HELOC does have a draw period, which typically for most lenders is 10 years. So once that draw period is up, it will convert into a fixed loan that you'll have to then pay off over the next, say, 20 years. Or you can secure a new HELOC in its place. Another important aspect of a HELOC is that the interest rate and the terms of your current mortgage are untouched. I mean, so many people have first mortgages at a 2 or 3% interest rate that they don't want to refinance. The HELOC is a completely separate loan with its own interest rate and monthly payment. It is important to note that if you utilize a HELOC, you'll be making two separate payments every month, one for your first mortgage and one for the HELOC. Now, all right, we've talked a little bit about how a home equity line of credit works. I want to chat a little bit now about how you qualify for one, because as I said, it's a separate loan. So there are qualification standards that borrowers need to meet. First, we have to make sure that you have sufficient equity in your home to borrow against. Equity is the difference between the value of the home and how much you currently owe on your first mortgage. Most lenders usually require you to have at least 10 to 20% equity left in your home after they'll loan you money for the HELOC. Some will even require a little bit more than that. In order to determine the current value of your home, lenders will use an automated valuation model or an AVM, or they'll order an official appraisal for your property. Second, you need solid credit score. A minimum of 620 is generally required, but having above a 700 is completely preferred, and it can result in more favorable loan terms, including a lower interest rate. Third is your debt to income ratio. This ratio measures how much of your monthly income goes towards paying debts and is a key indicator of your ability to repay the money you've borrowed. An important point here is that your current mortgage is factored into this. So if you have a lot of other debt, consumer debt, and a mortgage, you may have to look at rolling in that consumer debt in order to maximize that home equity line of credit. Last is your income and financial stability. Lenders will still require proof of steady income in the form of pay stubs, tax returns, or W-2s. So we covered what a HELOC is, how it works, and some qualification standards. I want to wrap up with just a few ins and outs that I want you to be aware of. Number one is that while HELOCs tend to have lower interest rates than credit cards or other types of personal loans, which makes them a more cost-effective borrowing option, the interest rate on a HELOC is variable. It's variable because HELOC rates are tied to an underlying index rate called the prime rate, which is a benchmark rate that reflects the general economy. Lenders will typically then add a markup or a margin to the index rate based on your credit score or your risk factors. So for example, if the prime rate today is 8.5, and the lender, based on your financial situation, charges a 1% margin, the HELOC interest rate would be 9.5. That 9.5 is the initial rate when you take out the HELOC, but it will change as the prime rate changes. Your lender should disclose how often you can expect your HELOC rate to adjust. Keep in mind, it could be as often as every month. The next detail I want you to be aware of is that your home is the collateral for the HELOC. This means that if you default on that HELOC payment, just like the first mortgage payment, your lender can foreclose you. So being extremely disciplined with both payments is essential, as you don't want to lose your home or deplete its equity. Your HELOC is also due in full if and when you sell your home, which means loan fees and closing costs could leave you underwater if the value of your home declines between the time you took out the loan and the time you sell. Basically, what I'm trying to say is that talk to a trusted mortgage advisor because they can take a really close look at your financial picture, as well as today's HELOC rates, and advise if a HELOC is your best option. Well, that's all I have for you today. So please leave any questions that you have down in the comments, and do not hesitate to give me a call if you want to discuss your home buying or your HELOC potential. Well, I'll look forward to hearing from you. Nicole Ruth with the Ruth Team.